Hi, everybody. Today I'm going to go over a quick valuation I did of Microsoft today. And I also have their most recent first quarter earnings report from a couple of days ago, I believe it was, for their financial year 2021. And their financial year 2020 ended June 30th. So I have that information here. I always like to go straight to the 10K because it's actually audited. And, you know, I just feel like that's the highest quality of information you can get. So, Microsoft has been going back and forth between the most valued company or the highest valued company in the world, switching back and forth with Apple. Apple currently holds it as of today's date of November 1st, 2020. And I think a lot of companies are overvalued right now. And I don't think people actually value the companies. I don't think they have any idea of how much, like, they're just like Facebook. I don't care what the price is, give me a share. But, like, to get a return on your investment, for example, is like we're gonna go look through here on Microsoft is just unbelievable. So, so I put in the last. This is how I value a company. I put in the last 5 years of their net income, and the growth rate I use for that on the basis usually earnings before tax. I do a compounded annual growth rate, which is a formula you can Google if you'd like to see. It's better than the average growth rate because it takes in effect compounding. So that's a true growth rate. And I do the 5 years. Some people do 3 years. I do 5 years to try to get a more, what's the word, long-term growth rate. And Microsoft is an old company, and they still have these great growth numbers. I take the growth rates of five metrics. Net income since 2016, they've compounded 27.4% each year. Since 2016, ops cash flow 16.2%, free cash flow 16%, earnings before tax 28%, revenue even for a company that old 16% compounded annually is ridiculous. Obviously, it's because they're switching more towards services than products, which I guess I'm going to have a higher uh, profit margin, which I'm going to add that to my model right here. Profit margin is simply net income over revenue. And then Control Shift, and now Alt H0 to add the decimal point, Shift, highlight over here, and then Control R to copy that. And I want it to be centered, so Alt H AC. There we go. Okay, so even the profit margin, but that makes sense because of going more towards services versus products and subscriptions as well. So the way I do it is I usually as an inconsistent formula because I changed the formula a little bit, a little less dynamic. I will go back and fix that though. So this range right here looks like I have 16% is the lowest, 28% is the highest. And I usually don't like to use the highest in my base, just being like what I say is the present value per share. I have it valued at $358.59 a share, which is dramatically higher than the price of Microsoft right now. But I just don't see any. And this model goes on for the next 10 years, by the way. So this is a 10-year model, and I just do not see that growth continuing for 28% continuing for 10 years. I mean, I think we're seeing just a switch from products to services that's helping their profitability, and their subscriptions are helping them reach a higher volume of people. So I think a more realistic, I'm going to use their revenue growth, and I feel a little risky using something that high, but for me, My perpetual growth rate, I always say a little bit. I say GDP, 2%. That's so far in the future, it's so hard to predict. I just put something low to be safe. Discount rate, I put high. That's a personal thing. You all could be using a discount of the 10-year treasury yield of 1.5% or whatever. If I change it to that, then, well, that's not going to work for me because let me do 3%. Because I have my terminal rate. My discount rate is going to have to be higher than my terminal rate. So if I put my discount rate at 3%, that's $783 would be a safe bet at a 5% growth. But I personally require 12% return if I'm going to invest in a company that I have no control over. So that's why I use 12%. It's the it's the average annual compounded growth rate for the stock market in general, reinvesting dividends, which is what I do. So, and this company doesn't even pay dividends, so I would expect at least 12%. Or no, sorry, Microsoft does, but still, I consider them almost a growth company now. So, still, I'd reinvest the dividend. So, yeah, I do want to discount them at 12%. Now, I don't really use the financial health in valuing the company, but I will use it as a cutoff whether I invest in them at all or not. Let's see. Let me fix that. I just recently redid some debt. Let me fix this. Current debt plus long-term debt over equity comes up to, see, that makes it, wow, okay. So it's actually a little more leverage. Control Shift 5, turn that to percent, Alt H0, Alt H0. So it actually is pretty leveraged out. I mean, it's got half as much debt as it does equity, which is fine. I mean, their current ratio is ridiculous, 2.53. Their quick ratio, which is their current ratio, but take out inventory. They have such a small inventory that helps their quick ratio to be 2.5, basically, which is ridiculous. And even if the company went out of business, I'd still say you would probably get about $16.77 per share just out of liquidation. Now I do tangible book value, which is something I created or something I made up, which is, let me fix it. See if that makes it better or worse. Okay, it's a little worse now. Mine is total equity divided by goodwill and intangible assets, because you're not going to get anything for those if a company goes out of business. And then B16 is total number of shares outstanding. So you got about $10 per share. If the company goes bankrupt, worst case scenario, you'll still have that. Intangible and goodwill. So this is the percentage of your total assets that are made up of the intangible and goodwill. 17% is not bad for a technology company. And here's the most recent earnings report that came out a few days ago. I just multiply them times 4 right now to get a rough estimate. Keep going at this rate, they'll beat revenue of last year. Will they beat earnings before tax? Yes. And they will beat net income by quite a bit. So yeah, if they keep going at this rate, they're going to do great. But I still wouldn't value them at anywhere close to their market price right now. This is my quantitative rate using my 5-year growth rate for the next 10 years, but I don't see it being that way. So I value Microsoft between this right here. If I could get the closer I can get to $67.62, I would go all in on. Anything below that is just a freebie. So please let me know if you agree with this valuation, if you disagree. And also if you have any more recommendations for me to value some companies. Right now I'm just going through company and the S&P 500 by market cap. So let me know if you have any other requests. Thank you.